every other season too. So if you don't want that, you need to drop out. So first of all, welcome everybody to our 12th session today in our AI Frontiers in Finance webinar series. And today we again have two amazing speakers with Roxana Mihet and Peter Brodehser. I will come back to those. And our topic of today is basically data centers. Is AI trained with public money? How are data center financed? What are the spillovers? And who is actually eventually paying for all of that, right? So before we can come to the topic, let me first of all tell you a few things about what to expect. First of all, we started actually last time, but for those of you who have been here last year, but now it's the first time in the 2026, so to speak, we moved from a monthly to a quarterly schedule because I think it helps us keep that at a very high quality in terms of speakers, in terms of content and everything. And we're going to have the next one, then I'm coming back to that after our discussion today in September in this year, right? So how you can get involved also, this has changed. You can, and then I come back to meet the team. You can now also use the chat function. So you're not basically in this Q&A thing anymore, and you can vote it up. You can immediately put your question into the chat and to participate live in the discussion that we have here. And now I come back to the amazing team that we have outside of me. I think these are the three ones who have started this AI in Frontier webinar series. Paulina is a PhD student here now at the end of or in the fourth year. And then Birgit Frankenberg, who is the owner and co-founder of HighPeak, a Frankfurt-based consultancy company. We started this webinar series and have continued developing over time. So coming to today's topic, as I said, this is a hugely interesting topic, specifically for us here at the Center for European Transformation, who is the host of that webinar series. We are basically working on everything related on micro level. How can transformation be financed? And of course, AI, data centers, infrastructure, it's at the forefront of what we are doing. So this is why I think this is a hugely interesting topic. And Roxana, who is currently an assistant professor at HEC Lausanne, is an expert in these AI topics and finance, has published extensively on that and is also working on that, and is currently, as she just said, basically touring across Europe, so to speak, basically presenting specifically that paper. How is AI trained and to what extent is this actually trained with public or taxpayer money? And on the other hand, Peter Brodehser, who is at DWS, he is not only a long-standing veteran, so to speak, in infrastructure finance, but also the infrastructure finance person actually that we have in Europe. So he's probably the most competent person to talk about that topic, and I'm particularly interested, given that Roxana has a relatively clear US view on this topic, to see how Peter says how this is actually playing out in Europe and what are the differences, and can basically these spillovers be expected to be similar in the US and also in Europe. So this will be a very interesting topic, and I'm very curious to find out more about that. Before I turn now to the speakers, let me stop sharing my screen, and we're going to do a short poll to get that discussion more or less started. So we're going to start with one poll now, and I'm going to put this up. So the local impact of the rise of AI. So the question is, what do you think will be the biggest local impact of the rise of AI? And the four answers is higher household electricity bills, more local jobs and business growth, higher local CO2 emissions, and then there's no significant local impact of the rise of AI. So I'll give you a few seconds, everybody can participate, and then let's see where we are. And then I'm going to let our both Peter and Roxana comment on that outcome. Let's do 5 more seconds. 5, 4, 3, 2, 1, and we're almost there. So we've closed the poll. That's the result. So one person said it's going to be higher house electricity bills, 11 out of 18 more local jobs and growth, 5 out of 18 higher local CO2 emissions, and also one no significant local impact. So now I hand over to both of you guys. Roxana, maybe you start. Is that sort of your ex ante prior of what people tell you when you ask that question?
Hi, everyone. Good afternoon. This poll is really interesting. So we're really in a very optimistic room. What I find really interesting is that really this question and this topic touches not just the technical revolution, the AI revolution, but it also touches the cost of living crisis. It also touches climate economics and climate change topics. And it also Right, and it also it also touches environmental topics and also capital structure topics. So I'm really happy to present to you today very shortly the project that I've been working on, where I'm going to show you who actually pays for the recent growth in AI. So give me just a second to set up my presentation. Okay, should be starting soon. I'm doing this from Barcelona. I've been at a conference here and I have a little iPad that I'm projecting things on. Okay, so it should be starting soon. Can you see anything?
Not yet. It's still
Not yet.
was still
I'm trying
yes.
again. Okay, it worked. Okay. Can you see anything now?
Yes.
Okay, perfect. All right. So I can start now. So this is joint work with my co-authors, Adam Feher, who is at the University of Lausanne, and Emilia Garcia Pendini, who is at the University of St. Gallen. So the main research question that we're trying to answer here is who really pays for the local AI infrastructure? And the idea is that AI really needs a lot of energy. And we're noticing a large increase in data center energy load. So the question is, as this data center load rises, are nearby households and incumbent firms bearing local costs, or are they also tapping a little bit into the local gains? So it's an important question because if you look around the US, you have local counties and states that are providing a lot of incentives, such as tax incentives and property tax rebates, and they are offering water, they are offering access to the energy grid, and they are also offering a lot of interconnection coordination. Now, these data centers, they are highly capital intensive, but it's not so obvious whether the benefits will also be local. Okay, so it's clear that the national upside of AI is diffuse. The benefits are happening. We're noticing it, but it is not clear that local communities can also benefit from this. So to give you an answer of what just a preview of what we find in this piece of work, and we try very hard to use the latest econometric statistics to answer this question, is that we actually do not observe any detectable average pass-through to household or commercial retail energy prices through 2024. So this is reassuring, at least up until now. And I'm going to present to you what I think is going to happen in the future, because I do not think the future will be similar to the past. Importantly, we also do not find any broad local gains in the businesses that are situated next to these data centers. So it does not seem that these businesses are increasing their revenue, their employment, or their investment in ICT technologies. And I'm going to end the presentation trying to argue that I think future costs and benefits really are going to depend on how the energy is procured. They're going to depend a lot on regulation. So on regulation, which means retail pass-through, how the costs of upgrades to the grid and energy generation are going to be allocated. So let me show you some data now. So on the left-hand side, and I can zoom in a little bit, you see data center electricity use from 2017 to 2024, which is a period that we focus on, and projections for the future. And you see that in the 7 years that we're looking at, the energy use of data center grew by a factor of around 1.2. Now, projections vary widely on trend, but also in the next 6 years. For example, the EPRI upper range says that energy load is going to grow tenfold. Now, if you look at where these data centers are, and here is a map from 2017, they are located all over the place, but primarily they are not located randomly. So they are located on the East Coast and on the West Coast. There's not so much going on in the middle. What's interesting is that they're not located in areas with low energy prices. So there is a paper by Greenstein at Harvard Business School that actually studies data center location, and they make the argument, they analyze a lot of data, and they reach the conclusion that data centers really are attracted by local incentives, in particular tax subsidies. So what we're now going to do is we're going to build up a very interesting data set of data center energy load from this source called the S&P Global 451. We are going to have retail energy prices for residential and commercial consumers from the EIA. We are going to have establishment level data on revenue, employment, ICT spending from this data set called SWZD Aberdeen. And we're also going to look at energy supply conditions from NERC and the EIA. I want to make just one point, just to clarify a little bit how energy prices are determined. I'm going to go all the way to here, just to show you a map of energy prices in the US. This is also a map from 2017. And you see that there's a large concentration. Energy prices are very high on the East, West Coast, and around Chicago, Minneapolis, Wisconsin, that area. Okay, so how are these energy prices determined? So first, there is a wholesale market where you have a lot of plants like nuclear power plants, coal plants, different generators that sell energy to different utilities at wholesale prices that are highly variable, and they move a lot. These utilities then allocate energy at different prices to different consumers. So there is another market on top of this wholesale market that sets prices for households, for firms, and for, let's say, factories. And this second market, the retail market, it's highly regulated. But there are some areas in the US where it is deregulated. Okay. So let me go now. Let me go now back to the presentation and tell you a little bit about the method. So how do we do? We have some challenges here econometrically. I'm going to go over this fairly quickly because I'm not sure this is of broad interest, but it's very difficult to answer this question of who pays, because these data centers, they use energy continuously. So there is a continuous treatment going on. Moreover, their entry has been happening in a staggered fashion. So you have more and more buildup and more like birth of data centers in the period that we're looking at. So we have staggered entry, and moreover, you have this endogeneity sitting issue, which is not so easy to deal with, but we use the latest econometric methods from this paper, Deschez, Martin, and co-authors from 2025, where the basic idea here is to compare similar counties. And we're going to compare counties, so similar counties in terms of population and GDP per county and a bunch of other variables. And we're going to compare counties where data center load is growing versus counties where data center load is staying stable. Okay. So the first finding that we have is literally no finding. So this is a very sort of difficult to sell paper, because this is a paper where we have no star, so we find nothing. So I'm showing here in this table so you should be looking at the second column, which is the preferred estimate. We try many different robustness tests, but what we find is that the residential prices, annual residential prices, they do not move. So the estimate is 0.01. And it's not significant. Commercial prices, they're also 0. So in economic magnitude, what this is, so if you take the top of the interval, of the confidence interval, the 0.124 number, what this comes out is an extra increase of about $120 per household per year. So this really is $10 per year at most, with the highest estimates that we can obtain. So this is really small relative to the policy debate, because if you are reading newspapers, there's a lot of worries on, well, energy prices that are really going up. Could this be due to data center increased demand load? And energy is a very important part of the household consumption basket, especially in the US, but also in Europe. We do this in different ways. So we try to we use other econometric methods to see whether this is a robust artifact. And so we do these binary entry event studies, and again, we find nothing. So if you look, we find nothing both before and after. So after the entry of a data center in a given location, nothing seems to be happening to retail, to household and energy prices. Most importantly, we do a lot of heterogeneity analysis, looking at those states that are regulated versus those states that are deregulated. So in a regulated state, in a regulated area, you would not expect the price to move a lot. You would expect the price to change, perhaps, or you would hope to see something in a deregulated state. So when we do that, we find, again, nothing. When we're looking just at hyperscalers or smaller data centers, we find nothing. When we are separating the type of, when we are separating the data center by the type of who owns the utility from which they are drawing energy, so whether it's cooperative versus investor owned, again, we do not find nothing. We try not just local, very local county level areas. We also try to look at commuting zones, and again, we find nothing. So the idea here is that this null is not just a definition artifact. It's not about how we measure things. It really survives alternative prices, utility types, regulation status, geography, neighboring counties. So we also look at spillovers or around a particular county, and they also survive hyperscaler exposure. Then the second thing that we look at is, are businesses seeing any local gains? And I was very surprised to see that this audience was very positive, because in the media is, if you look at the media, that's most articles are quite negative, quite pessimistic. So we do not observe that local businesses increase their investment in ICT. Relative to their revenue, again, the estimate is 0 and not significant. We don't see any change in employment. We don't see any change in IT employment. And we also see 0 change in profitability. So and this is economically, it's really, really small. So, and not significant. So there's literally no impact. So it doesn't seem that these host communities are receiving the broad firm level gains that they are promised, particularly by their local institutions who are trying hard to attract these data centers. Now the question is why? Why we have a large shock? We have a large shock, but we're not observing anything. So we try in the paper to think of 3 different narratives that can explain why this shock, this energy load shock is leaving such little footprint. Then the first, which we think a lot of it is going on, is that in the US, the energy supply it's increasing. So you should be looking at the first graph at the top on the right-hand side. And it is increasing in a stepwise fashion. When you have an increase in demand, where you're going, let's say, from D to D prime, you're moving along the step, and that's not going to generate a large price change. So that could be one mechanism. This idea that it could be that the existing infrastructure, well, a lot of hyperscalers, they are just using, let's say, nuclear energy, and these nuclear power plants have been able to absorb the entire extra demand. The second story could be, well, we know that some of these data centers or the largest big tech companies are contracting energy through PPAs. So these are private purchasing agreements. But here, most of them are virtual. What this means is that the PPA, it's not really constructing a plant next to the data centers, but it's really contracting energy for a particular data center, but this energy is coming from the grid. So even if there is a lot of PPA going on, we should still observe some impact on energy prices. However, if you look at the market prices, so the third story, if you look at the market prices of the largest independent power producers, so these are Vistra Corp and Constellation Energy in the US, what you see is a huge boom, but the boom is happening post 2024. So in our sample with our data, we don't seem to be capturing. Sorry about this. We don't seem to be capturing this large increase in PPA. It's there, but it's really happening in the last 2 years. The third explanation is that maybe we're not observing anything because tariffs are regulated. We analyze that story. We don't really think that that's going on, because when we are looking at deregulated areas, again, we see no impact. Now, I know that in the last couple of weeks, the largest tech players have signed an agreement where but it's not legally enforceable, but they are agreeing to not pass any infrastructure and T&D, transmission and distribution, cost improvements to households, but to really absorb everything. Now we will see what is going to happen in the future, whether they will keep this pledge or not. When we look at, we try to disentangle a little bit between these 3 different stories. We look at regulation. We don't observe anything. We don't think really that it's the PPA that is really relevant, a growth in PPA that is really relevant for the period up to 2024, but we think that this is really a major determinant of how prices are going to evolve in the future. And for regulation, we think it doesn't seem to explain what has been happening in the past, but it will be important in the future. How do we show that it is important in the future? Well, we build a little model and I'm not going to explain the model in detail, but we do a couple of simulations where we're increasing demand by, let's say, tenfold or threefold, and we have different scenarios. So what if this extra demand is all serviced through the grid? What if it is all contracted through PPAs? What if regulation is really bad and there is a lot of high pass-through to consumers? And the fourth scenario is what if there is a lot of access to renewables and storage technology? And what we find really is that it's not the growth in demand that really matters, but really procurement and regulation. So the highest increase in the bill per month, the $67.53, happens when in markets that are where there is a lot of high pass-through. So let me sort of conclude with some policy implications. So we think that the goal is not to stop data centers, but it's really to price and allocate the local grid costs transparently. We're trying now to do a little bit more analysis to see what happens to environmental outcomes. There was this CO2 emissions present as an option in the poll that was discussed. We did look at that. It's a very difficult question to answer because CO2, so it's not the data centers that pollute. What really pollutes are those energy plants that are, it's the coal plant that is generating energy. And that does not have to be located near the data center. So it's hard to observe the environmental impact locally. However, we're trying now to look at water because water is required to cool down and this water evaporates and this water really is local. So we think that we probably are going to find something there. Yeah, in terms for policy, we think rate design, procurement, interconnection, and incentives really matter. And this public money should buy some public benefits. They should not simply accelerate privately appropriated compute capacity when the gains are happening elsewhere. So let me conclude with this, with the first question that I posed. So is AI, which is quite provocative, is AI paid by public money? We think that yes. We think that the answer is yes. Local communities do pay through taxes because they are the ones who are paying taxes. They also pay through non-pecuniary costs. When a data center moves in your neighborhood, they are not pretty sites. They might also affect your water, but these local communities don't seem to be, so at least so far, they don't seem to be benefiting at all from this data center positioning. So thank you very much, and I look very forward to Peter's presentation and then to the discussion.
Awesome, this is great. Thank you, Roxana. Peter, move directly to you, and now I'm very curious to see what you think about what's happening also in Europe and where you see the differences.
Sure, very happy to. And good afternoon, ladies and gentlemen, also from my side. Just trying to share my screen and bear with me for a second to organize. Yeah, that should work. Yeah, ladies and gentlemen, the next 10, 15, maybe 20 minutes, I would like to take a different perspective. I'm not really an academic, to be frank and honest. I'm rather a practitioner, talking from the perspective of a citizen and as an investor. As Sasha just mentioned right at the start, I'm working as a MD, as a managing director at DWS, being responsible for the infrastructure investments of the group. And my day-to-day customers are predominantly institutional investors, life insurance investors, and we're advising also politicians how to attract capital and how we can find capital to be allocated and to be invested in important infrastructure assets. And to my mind, it's a question, I phrased it, who pays for the energy behind AI? And I try to make the thesis that it's not only about electricity consumption only, but it's rather about capital formation, which is, to my mind, even more important than the pure electricity consumption. What have we learned so far? And Roxana, many thanks for the great presentation. I think your academic evidence was there is no measurable increase in electricity prices where the data centers are based. We have no measurable impact on firms and no measurable increase in emissions. So we could come to the conclusion that the system has absorbed AI-related data center growth remarkably well. This is the case as of now. And I have 100% your chart on top of my head where you see a lot of increase of AI in the next couple of years. And my personal opinion is for sure it will have an impact on the society. It will have an impact on local firms. It will have an impact on emissions, etc. It's just a question of time where and to what extent it comes out. But is it really the most important question to ask who pays for the electricity? Or should we rather phrase it differently? Who finances the infrastructure before the electricity is consumed? If AI and infrastructure is an important topic. Let's have a look about on data centers and what costs are associated with it, or where do we need liquidity and to bear cost? First of all, that was the topic we just touched upon, OPEX, so operational expenditures on a daily basis, electricity prices, amortization and depreciation. Will we have costs fairly allocated amongst the parties? No. Will it be perfectly allocated? By no means. It never has been fairly allocated. It is not fairly allocated and never will be fairly allocated. That's my personal view. Just have a look at the fees for public broadcasting, which is pretty much a nightmare in the public discussion. And there you can see that it's not fairly allocated. However, do we need 100% fair allocation? No. If it goes 99% in the right direction or 90% in the right direction, I think we are almost there. So will an advanced economy find a way to absorb finance and ultimately distribute or allocate those costs accordingly? Almost certainly. And the most important thing is that, Roxana, you keep going with your research to enable the, let's say, society to allocate the cost to the right person triggering it. And this is a very important element, but I would like to take a different view that injecting CapEx, enough CapEx in that specific area is a question which starts even earlier before we can talk about allocating the OPEX here to the respective parties. Let's come to the second part, CapEx. What do I mean that AI is more or less a CapEx play? It starts on the left-hand side of the screen. If you would like to have AI, you need data centers. If you would like to operate data centers, you need electricity. If you would have electricity in your local area, you need transmission grids, so the highways for electricity across your country or across Europe. You need distribution grids, so the local roads and transporting electricity to the local areas where it's needed. You need battery storages to, let's say, save energy for the times where the production is below expectation and below the needs. And of course, you need electricity, which is capital. So the second thing, to my mind, having enough CapEx or performing with enough CapEx is, to my mind, a larger question than allocating the OPEX, because capital is a bottleneck and we see it inside out. It doesn't come as a present of the government that they showed up with a 500 billion infrastructure plan if there is no need. So there is a bottleneck of capital, and this is exactly the reason, let's say, create an environment to attract enough capital. And it's always that people are talking about AI and AI infrastructure as a cost. To my mind, it's an investment. And I'm mentioning this not only because of the fact that I'm an investor, but also as a citizen. So if you have enough AI infrastructure, you can compete on a global scale, and you can enable the economy to achieve future and further growth. And my line seems to be a little bit patchy. I hope you can hear and see me. Otherwise, Sasha, please feel free to give me a shout.
We can see you. The picture is frozen from time to time.
This slide shows predominantly another area which is attracting a huge amount of capital. So it's not only about okay, yeah. Thank you, Sasha. That's helpful. Yeah. So when we to AI, to data centers, we need to make sure that that there is sufficient capital. Are we short on capital? Just to elaborate a little bit on specific areas where we can see that capital is a bottleneck. You can see here on the left-hand side of the screen, so the bar for 2025, the Europeans' primary energy mix. What does it contain? It has 20% renewable energy, about 40% oil-related products, about 20% gas, and the rest is nuclear and hard coal, respectively, lignite. In other words, we have achieved 20% renewable energy, and we would like to increase that stake by 2045 or the latest by 2050 to 100%. And that is for two reasons. First of all, we would like to reduce the carbon footprint. But this is one thing. We want to be sustainable, we want to be green, we want to be ESG compliant. But the rather more precious element is, can we achieve in Europe a resilient economy that we are not relying on external fossil fuel sources? So if we have 100% renewable energy production capacities within Europe, we are not any more dependent on Russian natural gas. We are not dependent on hard coal we are importing from South Africa and Australia in huge blocks. So it's rather a question of having the security of supply for the population. And the energy supply, it's from a political standpoint, has, to my mind, the highest priority at all. The politicians will make sure that energy supply will be there at all costs, whatever it takes. Because if our heater shuts down tomorrow, if we don't have any electricity, if we don't have anything to eat tomorrow, because the supply chain will collapse, we have a severe issue across the country, across all Europe, and each and every nation and each part of the nation will be affected. So we are, while investing in data centers, competing with other asset classes. And if capital is scarce, we need to make sure that we present attractive business cases. So the challenge is not that AI requires capital, but the challenge is that many strategic priorities require capital at the same time. So it's not only AI and data center, but also energy. Now let's think about the idea where could potentially capital come from. I think what always works is asking the government to pay. That's the easiest version. Let's say we need to build data centers. Let's ask the government to provide the funds, and we are good. To my mind, that's the last line of resort. First of all, let's try to tap onto private investors that can play a predominant role here in financing these investments. And I like the chart having on the right-hand side of the balance sheet the institutional investors. let's say the life insurance companies, the pension funds, which more or less invest our funds for our retirement. The funds will sit there for decades when we finish university until we retire. It sits decades with them, and they can work with it over a long period of time. And they collect from private individuals huge amounts of funds, and they have billion asset under management. And they need to find the right investments on the left-hand side of the balance sheet that matches their requirements and matches their needs. And it's very important to bear in mind that we deliver to these investors what they desire. They have the requirement for, they would like to cover their long-term obligation. They have an ongoing payment commitment to their customers. They would like to be inflation protected, and they have regulatory requirements and solvency constraints. And while investing or trying to find investors on the left-hand side of the balance sheet, we need to bear in mind what they need on the right-hand side of the balance sheet. And the requirements I just mentioned, like inflation protection, ongoing commitments, long-term stable cash flows, then we need to achieve with each and every investment predictable cash flows, a certain duration that matches their right-hand side of the balance sheet, resilience, inflation protection, and diversification. And the politicians, they are starting always on the left-hand side of the balance sheet. How much capital is required? To my mind, we need to ask another question. How can we structure investment that it fits to institutional investors? Because AI infrastructure will not be financed because it's important. It's not the role of a CIO, of a chief investment officer, to, let's say, support the AI development. It's his responsibility to find suitable investments to cover the liabilities of his right-hand side of the balance sheet. Having said that, to my mind, the main challenge is not allocating the OpEx. We all will pay the check as we did in the past. And the real challenge is mobilizing CapEx, or not strategic importance or political ambitions that will kick it off and will mobilize enough capital. Because that's what the governments tried over the last decades, force institutional investors into investments, just mentioning, look, it's from a political and strategic standpoint important, so please invest. And this is not going to work. We need to have investable structures, attractive risk-adjusted returns, and liability matching and regulatory stability. Just to give you one example on the second point, attractive risk-adjusted returns. We are discussing with the regulatory authority for the transmission rates now for over 10 years that the risk-adjusted return is not sufficient. And why are they not just increasing the return? Because it increases the electricity bill for all of us. And it's not very famous for politicians to trigger higher costs. That's exactly the reason why they are not moving in that direction. But to attract enough capital to finance this, it will be, to my mind, of an utmost importance to have or to put a risk-adjusted return here in place. And again, we are competing with data centers and all the ancillary infrastructure with other sectors. And I mentioned the energy space, and this is just one element. Another element is transportation-related infrastructure. Another one is social-related infrastructure. That party with the greatest need for infrastructure, it's that party with the most investable opportunities. Our mind should not be viewed as a cost. It is a strategic, productive capital that enables future growth. And without exaggerating, if we have a independent AI infrastructure, we will definitely increase our competitiveness in the world. and being competitive in the world is also a geopolitical element. Point number 3, how quickly we can allocate it effectively to build the future we all want to see. Many thanks, Sasha, and back to you.
Awesome. Thank you so much, Peter, for your overview and your thoughts on this. Let me, before I give Roxana, give you in a second the moment to reply your views on that. Let me already start a second poll that we get a discussion going and people can already think a little bit about maybe also what's lying ahead. And while we're doing the poll, maybe you can already start sort of like responding a bit to what you think about Peter's view on the importance of basically the capital and the capital formation around that. So for everybody else, so the question is about cost coverage, right? So if you look into the future and think about future grid upgrades, which is needed for this AI infrastructure, who should bear the cost here? Is it the data center operators? Is it the electricity utilities? Is this the all electricity customers through rates, or the government and taxpayers? So maybe give a couple of seconds for everybody to respond to that. And then you can maybe start thinking a bit about what you think about Peter's response. So give me five more seconds here. 5, 4, 3, 2, 1. And let's end the poll and let's look at the results. So there's a clear view data center operators should pay. So let's maybe start with that. Roxana, give the floor to you first.
Yeah, so just I'll get back to this to the poll, but just to respond to Peter. So I agree with him that AI is a GPT. I agree that it's going to lead to huge increases in productivity and efficiency, and we're still waiting to see some complementary technologies that are going to help so that we can actually see this in the statistics, because we're seeing as Solo said, we're seeing the AI revolution everywhere, or the ICT revolution everywhere, except in the statistics. What I think it's not the issue. I don't think mobilizing capex is really the issue now, because there's a lot of optimism and a lot of AI-related opportunities and optimism in the market. Even if I'm suspecting that we're heading closely into a bubble, what I think really is the bottleneck for the next 5 to 10 years is really finding the energy sources, finding the plants that can produce the energy that is needed in a political environment that is very complex, and in a world where environmental and like climate change, it's obvious that it is happening. We're seeing that a lot of this. So, for example, for the case of Europe, so no, let me get to the case of the US first, and then I'll talk about the case of Europe. In the US, we're seeing that these big tech companies, they are getting desperate. So some of them are buying decommissioned airplane turbines from airplanes that were decommissioned during COVID. And they are using those to power cooling systems and to get energy in the data center. But these turbines, even in the supply chain, it takes, so if you have the money to buy a turbine, it takes about 7 years to obtain one. So that's a huge bottleneck for a data center. We're seeing that a lot of these big tech companies, they are buying nuclear power plants. So just last year, Microsoft bought a reactor in the decommissioned 3 Mile Island power plant. And I don't think it's operational yet. I don't think, or it's Google, sorry, not Microsoft. They are not using this yet. It's not operational, but likely I think this is I think this is going to be the future. And I also think the future is going to be a lot of smaller nuclear, like these micro nuclear power plants where you have many of them. And that might be good socially. It might appease worries about nuclear disasters. If you have, a smaller one, in case something goes wrong, the problems will be smaller than if you have a Fukushima sort of event. So I think it would be socially more acceptable. Now, in the case of Europe, I was talking to the head of the Swiss Nuclear Agency, and he was saying that in Europe, there are about, so he was saying, first of all, in the world, more than 50% of nuclear power plants are too old to function. So they have a life of about 30, 40 years. They were built in the 80s. We are now past their expiration date. So he was saying in the next 5 years, technically, we should decommission about half of them. In Europe, there are plans at the level of the European Union to build about 10 nuclear power plants. But because of the green wave, they don't have enough specialists. So he was saying from his expertise that they have specialists only for about 3-4 power plants out of these 10. So apparently it's not so easy to move the specialists from one power plant to the other so that you can build all of these nuclear plants at the same time. Plus, when you're building a nuclear plant, that requires a lot of red tape. Any small modification that you do requires, a 3-year approval. It takes a long time to design, to build it, to make it operational. So to me, that's the real bottleneck that we're going to see in the next 5 to 10 years. There's a lot of capital. There's a lot of optimism. Everyone wants, AI to grow, and maybe some of us want to even finance it. But I'm not sure I think energies will be a huge bottleneck. So with that, I'm going to open the floor to questions, opinions, and to the debate. Thank you so much, Peter. It was really interesting.
Okay, thank you, Roxana. Maybe so. Is there anyone in the audience who would like to chime in? Otherwise, maybe Peter, you already also have a second reaction to that. Otherwise, I have also something I would like to ask. So maybe
very, very happy to leave the floor to the audience. But Roxana, I think you're absolutely right. Energy is also a bottleneck. But let me add one thing: because of a lack of capital. This is also an element. Like what you said, the nuclear power plant, yes, fully agree. To my mind, we would have been better off to let them just run or replace them until we have enough renewable energy production capacity in place. To my mind, that's my personal view, would have been a better option. But yes, we will see a shortcut of electricity because there is not so much capital in the market to finance that. Just to give you a very pragmatical example, what I discovered during my daily operations, what am I going to do normally? I'm reaching out to project developers who are developing hydro plants, solar plants, wind plants, you can name it. And they need to sell their products to the market to recycle their capital to build new ones. So they are just developing them, building them, selling them to the market, and then they are investing their capital again, and then they go through the cycle again. And what they have as a problem, it's not enough capital in the market to sell or to buy the assets that has been finalized and to buy them from their books. And so they are now stuck with the assets. They would love to recycle their capital, sell it to the market and build the next plant, and they can't do it. And this leads exactly to the point what you've absolutely correctly described, that we have also a shortage of energy.
I just want to add to this capex bottleneck, and I also think there's a human capital bottleneck as well. We know to build solar panels, there are not enough specialists, and I'm sure that this is for different sources of energy and different types of energy. So there's a role for education there. To think a little bit about how are we going to change the education system to try to plug in this big hole.
We got a question actually from Inza from the audience, and said, I would be interested if Peter and Roxana could share any insights on the SMR, small modular reactors projects, which are in discussion to meet the data center's energy demand.
Yeah, Roxana, you want to go first?
I don't know much about these reactors. I have talked with some physicists, and they say that they all, for the last 5 years or 10 years, they always say we're 1 year away from being able to develop them. I don't think we're there yet, but I think that they are the future. And that's all I know. I'll let Peter say more about it.
Yeah, many things. And to be honest, I love them. And as soon as they become operational, that will solve a lot of issues. So the energy supply for local data centers, first of all, the security of supply, because you're less dependent on transmission grids and distribution grids and terroristical attacks on this kind of infrastructure. So you have the security of supply. Second thing, you can allocate the costs for these specific energy production facilities rather directly to the users which are using it. And to my mind, a decentralized electricity production is definitely key for the energy for the supply of security of energy, because one of the weakest parts in each and every country are the transmission grids. So the highways for transporting electricity from A to B, and the more local production facilities we can implement, the better we are off. So to cut it short, I love them and I wish to see more of them, and very happy to step in and try to finance these things with the investors willing to invest.
Awesome. Maybe one question from my side, because I'm a little bit new to that kind of topic, so to speak. These private purchasing agreements when it comes to energy, how does that work? And where do you see that these might become actually an issue or bottleneck going forward?
So I'll reply to this, and I think Peter knows way more about this than I do. So my understanding is that these are contracts where a data center contracts a certain amount of electricity at a certain price years in advance. And the utility is obliged, when the time comes, to provide this electricity at that price. But they do it through the grid. So most of them are through the, I think, around 80% or so are virtual. They're happening through the grid, and only about 20% are off the grid. So off the grid meaning you have some independent power producer putting some wind turbines next to the data center, and you're connecting directly to this wind turbine, and that's off the grid. But that market, so it's growing a lot. The renewable market in the US, I know it's growing a lot. I don't know about the case of Europe, so I'm happy to see what Peter has to say.
Yeah, thanks, Oksana. So the PPAs, so the power purchase agreements, they play a very important role in today's market. They are replacing more or less feed-in tariffs, as we've seen them in Germany or in Spain or France or else, where it might be called a feed-in tariff, it might be called contract for differences in the past, but this is more and more to be phased out. All these subsidies, and a feed-in tariff is a subsidy, they will disappear from the market when the electricity prices will go down and renewable energy can compete with other sources for producing electricity. And these PPAs, they serve the needs of two sides or two different parties. One is a source of secure energy supply for a data center, for example, that one hyperscaler says, look, I would like to buy energy for the next 2 years, and I want to make sure that the electricity prices won't move with the market, but rather stay stable at a certain amount. So it saves the providers of data centers. And on the other hand, it serves also for the electricity producing companies, because they have the certainty that there will be an off-taker for a certain price, that the electricity prices will not drop and jeopardize their business case. And it's one of the most critical and important elements.
I will come back to that, but before it's already late, there's one more question from the audience. So Detlef is asking, it looks like as if many skilled workers will be needed. Meta announced recently the Workforce Academy in Louisiana. Could this be a competitional advantage in Europe? Do we have more skilled workers?
Yeah, so I didn't know actually about this Workforce Academy. I was just Googling it. So it's a training center where they want to train AI data infrastructure jobs. They want to train AI infrastructure related skills. I'm not sure what Europe is doing for it. I think it's definitely something to consider, but I don't have much information on it. I know that certain countries like Spain, they are investing heavily both in education and in renewable energy and in the infrastructure itself. But I only know the case of Spain, whether it's generalized across Europe, I'm not sure. And clearly the winner is going to be the first mover. Yeah.
Peter, do you have a view on this?
Apologies, I didn't get the question because the line was a little bit patchy.
Yeah, sorry. The question is, sorry, many skilled workers will be needed. Meta announced a Workforce Academy. Could this be a competitive advantage in Europe? The need for skilled workers.
Yes, definitely. It can be a competitive advantage, but it can also be a huge disadvantage because labor in Europe is still quite expensive, more expensive than in other parts of the world. And it's definitely a competitive edge if we're good in this area.
And it all depends what will happen to immigration and like geopolitics. It's very complex. There's so many important things happening all at the same time. So we're living in very interesting times.
Yeah. There's also another interesting question that we have in the chat. So I'm curious whether you see a role for PPP models, so public-private partnerships, at the data center level itself. Do you think there could be use cases where governments and private operators jointly develop or finance data center capacity?
I think this is more a question for Peter.
So the clear answer is a yes and no. Where do we normally see PPP models where the government tries to build something? For example, a university or a road that is foreseen to be provided to the wider public without any fees. For data centers, it would be an option like a data center attached to a university, a data center operating for a government function. And in this regard, yes, of course. And how does this PPP model, just for the sake of transparency for the audience, how does the model work? Normally, the government has the option of either acquiring the asset directly. Currently, we are looking at a police station, for example. I'm not naming them, so I can speak about it. And we are looking at a police station, and this police station contains office buildings. It contains sport facilities, jail areas, etc. You name it, what belongs to a police station. And the government said, okay, I can buy that facility straight away, or I can get a private company just refurbishing it and being by far better in doing so than a government authority would be. Have a look at the airport Berlin. It answers a lot of questions that the private companies are normally more efficient than the government structures. And they can then get a fast delivery, a good pricing for this, and pay a kind of a so-called availability-based payment to the private operator. It might be Vinci Concessions, the French operator, it might be Hochtief or Strabag, you name it, and pay them an availability fee over 30 years for the period of the concession. And this is a model which could be applied for data centers that are under the wings of a government or a public authority. It won't cover all the privately used data centers, because to my mind, yes, it could be paid by the government, but it would be in terms of allocating the cost more fairly, rather being under the wings of the private companies or private users to pay for that. Sasha, you're still on mute.
Sorry. I was saying, Angela has another question here, or one question here also. So in terms of capital allocation, what is your view on private markets as increasing source of capital flows into different electricity infrastructures in the US specifically? There's a new rising owners, for example, power plants, and these are private equity, institutional investors, and foreign corporations. Some studies show that PE and foreign corporations are disproportionately financing new solar, wind, natural gas plants, while domestic public utilities play a smaller role. And thank you very much for a wonderful presentation and discussion.
So I can only agree. These are what we're seeing. We're seeing a lot of PE, private equity, not just in electricity infrastructure, but also in these data centers themselves. You have private equity funds buying depots and then renting the space out as if it is real estate, renting it to different collocators. I think we'll definitely are going to see more and more of that.
Yeah, for sure. And one element, just to pick up one, that while domestic public utilities play a smaller role, and especially the municipal utilities in Europe, they will have a severe issue over the next years to finance their needs, because you remember for the subsidy package the German government brought in place, the 500 billion, they were discussing that a kind of 100 million was kind of earmarked for the regional parts of Germany. And this goes exactly to the municipal utilities. So they will face definitely a shortage of liquidity, and more and more capital will flow into the private markets. To my mind, we will see a huge rise, especially in the infrastructure space, but also on the private equity and private debt space. I see for real estate, I rather see outflow of capital over the next decade, but inflow private equity and private debt, the inflows will be significant.
Does this fit into this private credit framework at this point? So we had this discussion also with some practitioners recently, and there was a strong argument by them that that's still mostly investment grade. The rents or the yields are not high enough. So this is not necessarily something where private credit would be in. Do you see this differently, or is this sort of an expansion of the business model, or how do you see that?
Yes and no. So there is not such a thing, to my mind, as the institutional investor. For example, before I joined DWS, I was running the infrastructure business at Talanx, so the German insurance company, and was quite an interesting animal to deal with, because you had a reinsurance part of the group, you had an industrial insurance, and you had life insurance groups or several life insurance entities, and their investment needs are very different. So a life insurance, 2 to 3% return is enough. The longer the better. 30 years, not a problem at all. For a reinsurance company, it's a very short duration, because if a storm like Katrina kicks in, you need a huge amount of liquidity today, and therefore a completely different investment appetite. The life insurance entities, euro denominated, for the reinsurance companies, US dollar denominated, and so forth. So for some investors, if you would talk with a reinsurance company, they would say, private debt, no, too low yielding, risk is not enough, liquidity is not enough. I'm very unsatisfied and unhappy with the asset class. If you talk to a life insurance company, they say, it's great, it's great. What else do you require? 30 years of tenor, 2 to 3% return, exaggerating, but so it depends on the structure of the right-hand side of the balance sheet of the investor.
Mm.
And it also varies from country to country, without boring everybody here to death. But just a couple of thoughts. So let's talk about ESG and the perception of the investors. So 5 years in the past, ESG was on everybody's radar screen and on everybody's menu. We were just touching investments when they were ESG compliant, and talking in terms of SFTR, at least Article 8, if not Article 9. In Germany and most other parts in Europe, the importance of ESG has been significantly reduced. Nobody wants to have Article 9 investments anymore, except one country, Netherlands. So they are still partially based on regulation, partially based on public expectation and requirements of investors. They have a very huge requirement for Article 9 funds, etc. So it's not like that an investor is a stereotype. This is how investors act, but rather it's a very heterogeneous universe. Yeah, apologies for stepping in, Sasha.
No. Definitely, this is great. No, you're definitely boring anyone. So even though we're way past the time, people haven't dropped out afterwards, after the 6 cutoff mark. So, but I think we need to come to an end. I think it's a great discussion, and I definitely will reach out to both of you afterwards, or bilaterally also, with a couple of questions that I actually have. But first of all, thank you so much, and let me briefly also from my side, just to show those who are still there, everybody else misses it, of course, that we have our next webinar in September, on the 8th of September, and Albert Mengfeld is actually virtually coming to us and talking about AI errors, and specifically sort of in the asset management or asset allocation area, how basically the errors done by AI vis-a-vis what's been done by humans. So it will be an interesting discussion. So thank you everybody for participating. Thank you, Roxana, Peter, taking the time to talk with us, discuss with us, and see you guys in 3 months in September when we have our next webinar. So thank you so much, and have a good evening.
Thank you. Thanks to you and the entire team for the invitation. I wish everyone a great summer.
Thank
Couldn't
you.
phrase it better.
Thanks a lot.
Thank you.
Looking forward to
Cheers.
see you in Frankfurt, Roxana.
Bye.
Cheers.